The screen opens on a trading floor in early 2023. Traders are watching NVIDIA's stock price skyrocket. Cheers erupt as it crosses $1 trillion market cap. The scene quickly shifts to a montage. Venture capitalists throwing money at AI startups, news headlines proclaiming AI will change everything, and tech CEOs making grand promises about artificial intelligence. We've seen this movie before. The settings are different, the technology has changed, but the plot remains hauntingly familiar. This is the story of the AI investment bubble, a tale of extraordinary innovation, unprecedented hype, and the dangerous intersection where technological promise meets financial speculation. Welcome to the greatest show in modern markets. The trigger was November 2022. OpenAI's release of ChatGPT didn't just introduce a new technology, it unleashed a global phenomenon. Within 2 months, it had 100 million users. But more importantly, it gave Wall Street something it desperately needed: the next big narrative. The AI arms race had begun, and money started flowing like never before. The parallels to the 1990s dot-com bubble are both striking and terrifying. Then, it was companies adding .com to their names and watching their valuations soar. Today, it's the AI suffix that works like magic. Startups that once struggled for funding are now raising hundreds of millions with little more than a PowerPoint presentation about their AI strategy. At the center of this storm stands NVIDIA, the company that has become the ultimate pickaxe seller in the AI gold rush. While the companies mine for AI gold, NVIDIA sells the tools. Their graphics processing units have become the fundamental building blocks of the AI revolution. The numbers are staggering. NVIDIA's stock surged over 200% in 2023 alone, making it one of the most valuable companies in the world. But this incredible run has raised uncomfortable questions. Is NVIDIA's valuation based on sustainable demand, or is it feeding on speculative frenzy? The company's price-to-earnings ratio tells a concerning story, trading at levels not seen since the peak of the dot-com era. The startup landscape is even more extreme. AI companies with minimal revenue are achieving unicorn status in record time. Anthropic, founded by former OpenAI researchers, raised over $7 billion in just 2 years, despite having virtually no revenue. Similarly, Inflection AI and other newcomers are reaching billion-dollar valuations, while their business models remain largely theoretical. Venture capital firms, terrified of missing out on the next Google or Amazon, are pouring money into AI startups at a pace that recalls the worst excesses of 1999. But the hype extends far beyond pure-play AI companies. Established tech giants are desperately rebranding themselves as AI companies. From Microsoft's massive investment in OpenAI to Google's frantic AI push, every major tech company is now an AI company. The phrase AI-powered has become the new blockchain-enabled, a magical incantation that instantly increases a company's perceived value. The results are sometimes comical, with companies slapping AI labels on products that are little more than simple algorithms. The corporate spending spree is equally remarkable. Companies worldwide are announcing billion-dollar AI initiatives, often with vague promises of future productivity gains. The reality, however, is more complicated. Early studies suggest that many AI implementations are failing to deliver meaningful productivity improvements. The cost of implementation, the need for human oversight, and the limitations of current AI technology are creating what economists call the casualty AI productivity paradox. We see the technology everywhere except in the productivity statistics. The semiconductor industry has become the epicenter of the investment boom. Companies like AMD, Intel, and TSMC are all riding the AI wave, with their stocks surging on expectations of endless demand. But semiconductor markets are famously cyclical, and the current capacity expansion suggests we might be heading for a glut. The massive investments in new chip factories assume that AI demand will continue growing exponentially, a dangerous assumption that has burned investors before. Venture capital's behavior is particularly telling. The same investors who preached fiscal discipline during the 2022 tech downturn are now throwing caution to the wind. Funding rounds are happening at unprecedented speeds, due diligence is being shortened, and valuation multiples are reaching levels that defy traditional financial logic. The fear of missing out has overwhelmed the fear of losing money. Several warning signs are flashing red. First, the valuation multiples for AI companies have completely detached from traditional metrics. Companies are being valued at 50, 60, even 100 times revenue, multiples that only make sense if you assume near-perfect execution and total market domination. Second, corporate spending on AI is starting to show diminishing returns. Early experiments are proving more expensive and less effective than promised. Third, regulatory clouds are gathering. From copyright lawsuits against AI companies to potential AI regulation from governments worldwide, the legal landscape remains uncertain and dangerous. Perhaps the most telling indicator comes from the companies themselves. While they talk endlessly about AI in their earnings calls, many are struggling to implement it effectively. The gap between AI ambition and AI execution is becoming a chasm. Meanwhile, the workforce implications are creating additional headwinds. The cost of hiring AI talent has skyrocketed, with top AI researchers commanding salaries in the millions. The screen shows a split image. On one side, we see the glorious promise of AI, revolutionary technology that could solve some of humanity's greatest challenges. On the other, we see the financial reality, a speculative bubble that's creating massive wealth destruction risk. The question isn't whether AI is important. It clearly is. The question is whether current valuations reflect that importance appropriately, or whether we are witnessing another chapter in the long history of financial manias. As we approach the likely peak of the hype cycle, smart investors are asking hard questions. Which companies have real AI capabilities versus those just using the buzzword? Which business models are sustainable? Which technologies will actually create value versus those that are solutions looking for problems? The final scene shows a modern version of the famous 1999 Pets commercial. But this time, it's an AI startup's mascot promising the world. The commercial ends with the mascot whispering, "This time it's different." The screen fades to black, leaving viewers to ponder whether they've heard those words somewhere before. The AI revolution is real, but the AI investment bubble might be its first casualty. The only certainty is that when the hype clears, we'll discover who was building the future and who was just selling dreams.